Welcome to the Eye on Annapolis Local Business Spotlight. There are thousands of locally owned businesses in the area, some small and some large. Some you may know and others you don't. But one thing they all have in common is a great story, and we want to share it with you. Join us every Saturday as we talk to the founders, the owners, and the managers of local businesses you have come to know and love, and those you will come to know and love. Now here's your host, John Frenay, with this week's Local Business Spotlight.
All right, well, we jumped up here to Movement Mortgage, which is out on Bestgate Road. It's 635 North Bestgate Road, which is right sort of across from the St. Mary's football field, I guess is the easiest way to talk about it. It's the old Bestgate Road. And we're with Lori Schramek and Joe Whilden. Did I get their name right?
You absolutely did.
Whilden?
Yep.
And we want to talk a little bit about mortgages here. First of all, I got to say the website is movement.com, which is an absolutely amazing URL to have. I'm surprised that it's that it's that simple. Let's get some background. I mean, Lori, you and I have met. We were members of SOFA, which is the South of Forest Drive Business Association. And I guess let's find out the background of both of you guys and how you guys got into the mortgage business.
I started about 7 years ago down in Alabama. I was just looking for work once my youngest learned how to drive. I had a friend in the business and she was looking to hire some people. So shortly thereafter, I moved up here, just got connected with a different company other than Movement. We've been with Movement here for, a year now?
A little over a year, yep.
But no, I love math. In college, I was originally an accounting major and didn't want to sit at a desk my whole life, and so switched over to operations management. And then I think if I'd have known what mortgages were back then, I would have probably jumped into the business at that time.
From bean counting to house selling,
exactly.
Different kind of beans.
Yeah, I mean it's still working with numbers, but you're out and about talking to people and helping people, and it's cool because you're helping people with their largest investment for most people in their entire lives.
True. Joe, how'd you get into it?
That's a funny story. So I graduated college in 2018 and I moved to Austin, Texas. I've got a very... Yeah, right.
Honestly, Austin's
no, it definitely has gotten a little crazy, too crowded over the last couple of years. But I had a bunch of family down there. I've got a very rich Texas history, so it was always kind of my plan just to get down there. And I was there for about 8 or 9 months, and I went down there because I was actually hired to be a pharmaceutical sales rep. I was going to work for the company Allergan, which is now AbbVie. They do the Botox products. Basically, that just got drawn out. They were waiting until AbbVie essentially bought them out, and it just never started. So I went from Texas to Florida. I worked for a small company in Florida called the World Wake Association. They're essentially an insurance policy if you want to have wakeboarding competitions. Okay. It was a cool job, something that was exciting. I'm a creative type of person, so I kind of fit in very well there. And then COVID happened. So COVID had me packing my bags, and I moved home from Florida. And as soon as I got back, it was just kind of a restart. Hey, what am I going to do now? Which route do I want to go in? Because again, I was a recent college graduate, is not even 2 years at that point. And I had really nothing set up. So 2 of my close friends are like, Joe, you could sell ice to an Eskimo. Why don't you do mortgages? We're currently in the middle of a mortgage boom, in case you didn't know. So
I've heard the rumor.
Yeah, right.
Probably didn't.
I really didn't. You don't know what you don't know. But I said, okay, yeah, I'm looking for something. I want a real career. And I've always, I don't come from money, so buying a house was a huge deal for us when we were young. And, we lost that house, and I've moved 22 times in my 27 years. So that's a whole nother story. But helping people get into a home that is actually their home, a place where they can grow their roots and create a family, all that good stuff, that's huge to me. And being able to help people with the biggest purchase of their lives in some scenarios, there's nothing better than that. I went from retail, wasn't doing it, now I'm getting people houses.
We've all been there, done that. It's got to be very rewarding for both of you. Now, how long has Movement been around? And I mean, how large of a company is Movement?
So Movement, about
2008, we started.
A little over a decade, I would say.
Financial.
That's more than a decade at this point.
Yeah, I know.
That's crazy.
16 years.
16 years,
what happened the last 5 years?
Yeah. We're based in Charlotte, North Carolina, and we're all over the country. We've got branches in every state, and growing.
Very cool. As we talk about the real estate industry, okay, you're not selling houses. You're not doing home inspections. You are the money people. You're the ones that figure it out. Now, the role of a mortgage company is to find the money. I mean, you guys don't actually fund?
Yeah, we do.
Oh, you do?
We do. We fund them, and we also service them as well.
Which is not very common in this
huge.
industry.
Yeah. So we'll sell the loans to like Fannie Mae and Freddie Mac and all of that. That's just part of how it works. But most companies and brokers will sell the servicing rights to the loan, meaning that's why like you may get a loan with XYZ mortgage company and then your statement says Mr. Cooper on it.
Right.
Or
you're like, who's
M&T
Mr.
Bank.
Cooper? I mean, we've got to be suspicious now.
Yeah, exactly.
Right.
But that's the reason why they do that is so that they can get more money to then fund out. But Movement was actually very, very smart. I don't know the full details in this, but during the pandemic is when they made the move to keep all of their servicing in-house. Well, that was when all the rates were super low, right?
Right.
So nobody's refinancing, nobody's paying those loans off. So that's really what has been carrying Movement and, continuing to do so well in spite of the recent, hiccups in the industry. It's
when you fund a loan, okay, if I'm buying a $500,000 house, which, okay, let's be more realistic. I'm buying a $750,000 house here in Annapolis. But, okay, in the back room here, there's a big safe with like $1 million or whatever it may be. And say, okay, fine, here's your $750,000. Go pay off those people. And obviously we use checks. Actually, we probably don't even use checks anymore. It's probably all wired.
Yeah.
So now all of a sudden your safe has only $250,000. What happens to the guy? I mean, where does the funding keep coming from? I mean, do you, as a company, Movement, go out to investors and say, hey, we're kicking ass. We need another $300 million.
Yeah, pretty much. Yeah.
And they realize that the returns on that they're getting.
Exactly.
And they'll turn around and give that, and then that replenishes the safe. Where is the safe stored in here? Just asking for a friend, okay?
Can't disclose that information. But no, that kind of circles back to what she was talking about, how, they made the decision to service during COVID when everything was low, because that's a huge issue for companies. You'll fund a loan and then they'll refinance it within 3-4 months if there's an opportunity, and they're essentially losing money on that. So the fact that they made that decision when rates were low, they're never going to lose that business. They're going to be servicing those loans until they're paid off.
It's got
or sold.
Got to be
and
comforting.
It's a better experience for the client, too.
I was going to say, it's got to be very comforting for a homeowner to be able to turn around and, call up, hey, Lori, I got a question. My mortgage just went up, and I mean, okay, so maybe it's a tax thing or something like what's going on here. And to not have you go, oh, yeah, call 1-800. We don't give a damn.
Yeah.
Right.
Essentially, yeah.
And you can sit there and say, and I may call 1-800, I don't give a damn. And they say, oh, yeah, no, that's not us.
Mm-hmm.
Call
we didn't originate the loan.
1-877, they don't care.
Yeah. Nobody as a client or a customer of any type of service or product or whatever, you don't want to get passed on to somebody else. Like,
True.
it's just a better client experience. Right. So
I've seen some horror stories too, where I've had clients close and they've set their mortgage up, they've made 2 payments, and then they're sold to M&T Bank. And then, I guess I shouldn't name drop another company, but they can't log into that account. And then months go by and they're still having these issues. They're having to call in their payments. They're doing things that they shouldn't have to do, that they wouldn't have had to do if their loan wasn't sold to another servicer. So especially for, the older generation, to have your loan sold multiple times and have to set up new accounts each time, and you might not even be aware that your loan was sold, it creates a huge headache. It creates just a huge issue for the client and for us, because now we're having to allocate time to try and help them when we're not even the ones servicing the loan.
Why do I want to go through a mortgage company, Movement Mortgage, as opposed to, we'll throw the name out because you started it, M&T Bank or Severn Bank, or which isn't there anymore. What's the Shore United or CFG or
you want to answer
whatever.
That?
I mean, what?
I'll answer the first half. You answer the second half. Right? All right. So there is a whole side of this business that I will let Lori touch on that goes back towards the communities. We're amazing with that, and I won't step on your toes there. In fact, you want to start with that because it is amazing what Movement does.
Okay.
We open schools for impoverished areas. We're continuously going on mission trips and, serving impoverished communities, helping people that need us. And a lot of the profit that we're making is going back into the communities that we
49% of our profits go back into communities. So we have Movement Foundation. Each employee can nominate any and as many charities as they want for this. It's regular. Is it twice a year? We've only been through it twice. We've been here a year, so this is the second round where we nominate, and then a few months later they put the list out, and it goes by region, and each employee gets to vote up to 5 charities, and they get $10,000 grants.
Oh,
so within each region. So, like the ones that we're voting on they're either national charities or local charities, like the Bernie House, which is what I nominated. So we'll give them a little plug. But yeah, and then each employee collectively votes for up to 5. So you're voting even for charities that you may not have nominated, and they give them a $10,000 grant. There's no strings attached. And yeah.
Well, that's, what it's all about is keeping it local into the community.
Yeah.
That's what sort of makes the community go.
Mm-hmm.
You work with realtors. What in a transaction, is it better or is there a difference to, when I purchase my houses, it's always been the realtor sort of drives that train and would bring you guys in toward the end. Or does it make sense to maybe identify a mortgage lender first? I know you've got the pre-qualifications and stuff like that, but a lot of times the realtors will turn around and say, hey, here's who we recommend, which, may be the perfect recommendation, or it may be a little bit self-serving.
Mm-hmm.
Yes.
Possibly. If you don't need financing, obviously there's no need to talk to a lender, right?
Right.
And you just go straight to the realtor. But my big thing with that is a lot of times folks,
The system is flawed.
Yeah, and I wouldn't even necessarily say that it's a system. It's more like just
You don't know what you don't know.
Need to know. People think that they need to go to the realtor first when they're ready to start buying. A real estate agent really can't help somebody that's not ready to actively start looking at homes and make offers.
And the only way you can tell if they're ready to start making offers is by determining what kind of financing they can qualify for. So in a perfect world, they would come to us first. We would let them know what kind of home they can qualify for, and then they'd go to the real estate agent, because the realtor, they can show them homes all day before talking to us, but they can't write offers before talking to us.
Yeah.
That makes sense. I can spend a day looking at $10 million homes.
But if you don't,
but if I don't qualify for $10 million, I need to be looking at those $750,000 homes.
And then you just waste the entire day of the real estate agent, because if they're willing to take you out to see these $10 million homes without knowing you can buy them, they just spent a whole day showing you homes when you might be a $250,000 house type of person.
Yeah.
And so it's definitely in everyone's best interest in the transaction to see us first, but that's just not how it goes, which is why we have to make those relationships with the real estate agents.
Yeah. And there's really nothing worse than falling in love with a $500,000 home when you can only afford a $300,000 home. It's two different animals. So, but the other thing I want to add to that, John, is so many people don't understand the impact that their income or their credit score has on their ability to afford a home and get pre-approved. So.
Okay, you're looking at my notes now. That's what I've got. When we look at people that are mostly first-time home buyers, I would probably say. And what percentage would you say are first-time home buyers come in through you guys?
Oh, for me, probably at least 50% or more.
I would say probably closer to 60, 70% for me.
And I would imagine that as your careers advance and as Movement advances their business, that number probably shrinks a little bit, and you probably end up, as people turning over houses are coming back, because of the experience that they had with you.
Exactly. Yeah.
Until you guys are retired, Joe, you got a little bit more years, but
hey, hopefully not. Hopefully not. Maybe I'll retire early. We'll see.
What are the important criteria for getting a mortgage? You hear all the time about, okay, get your act together before you do it. So what is that act?
So that would be, I would say, start with your credit, right,
100%.
Joe? Yeah.
100%.
You can have a decent credit score, but if you have a really good credit score, you're going to have more opportunities. You're going to have better rates. We've got, Maryland Mortgage Program has a program called Smart Buy that they will pay up to $20,000 to your student loans. Phenomenal program. But you got to have a credit score of 720. So that's a pretty good credit score. Most people, their credit scores are in the 600s. Somewhere in there. So I'm looking at someone that's got, $20,000 in student loan debt or more, and it would be a great program for them, but they're not eligible for it because of their credit score right out of the gate. But if I have a year to work with them or 6 months to work with them, we can help them get their credit score up. There's different things that you can do to improve that.
All right, let me, okay, you just mentioned something. You said you can work with them for a year or something like this. I mean, so this is, come to Movement Mortgage and you say, okay, well, I'm looking at $500,000 houses. And you say, well, you're only about 250. Sorry, we can't help you. But you say you actually will work with me
Absolutely.
until I'm able to get to that 500,000 or whatever level that I need.
Yeah. And now you've got to have the income. I mean,
Sure.
Another element to it. But if your credit score is holding you back, because the lower your credit score, the higher your interest rate's going to be, and the fewer programs you'll be eligible for.
That's awesome.
Anything you want to add to that?
Another huge piece of the qualification process is one that most people don't know about, your debt situation. And we're not looking at your entire debt. We're looking at what your monthly payments are on those debts. So, you might be like, hey, I've got $50,000 in student loan debt and I have a $40,000 brand new truck that I just bought and I've got credit cards. I can't buy a house. Well, good news. We're not using those full amounts. We're looking at what the monthly payment is. So if that truck you bought is $800 a month, you're hurting yourself more than you're helping yourself, because we're using your monthly income and we're comparing it to your monthly debts. So on a conventional loan program, you can't go above 50% of your debt to income ratio. So if you make $5,000 a month, we can't get you over the $2,500 mark on a conventional loan. On an FHA loan, we can go a little bit higher, and there's different loan programs that accommodate different things. But the debt situation is a huge piece. Those student loans that were in deferment all those times, they weren't coming with monthly payments, so people thought they just didn't need to look at them. There's a lot that goes into that, which also ties back into the credit report, because that's how we discover all of this. There's things that are on that credit report that they didn't even know about, like late payments or collections or whatever you might have. We're going to see that up front, and that's really going to dictate how we can proceed with the process.
Well, that's a good lesson to lock down your credit report to make sure, and also to check it annually.
Absolutely.
Just, whether you're buying a house or not, it's always good practice. I know when I bought my very first house recently out of college, way back when Sears used to have a credit card, and you could buy like Montana, Hawaii, and Alaska, and $15 a month, was your payment. And we went in, and my wife and I went in, and the bank was like, "Oh, this is a hot mess." And they said, "You're not going. I mean, you're going to get somebody's going to write it at like 9.5% or something like this." This is back in the '90s, early '90s, and so he said, "Look, I'll tell you what." And again, it was based on the community, very not dissimilar from what you guys are doing with Movement. They said, "Look, we know you. We know that you live in the community. We know that if you shift your banking to us, we'll hold it."
Yeah.
For a while. And I mean, there was a banker, there was a relationship that was able to do that. So, I mean, I think it's fabulous that you guys are building your business on relationships.
That's the name of the game.
What'll kill a deal? I mean, is there anybody that can't buy a house? I mean,
inspections.
But I mean,
that's not lending. Appraisals.
Well, I mean, okay, Joe, you had mentioned that, you've got to have the income and everything else to support it, but what customer comes into you and says, I want to buy this house, that you look at and go, it's just not going to work right now? I mean, what does that customer look like? It's obviously, you said you can work with credit scores to a degree.
Mm-hmm. So sometimes, like I have a client that I talked to earlier today that she's got several credit cards, and that each credit card has a minimum payment. She's maxed out several of those. But the balances were like $300, $500. And so she's trying to squirrel away money for the down payment and closing costs. And it's really going to benefit her better if she pays off some of those credit cards, eliminates them. And then that increases her utilization, so to speak, which is a credit score thing, right? So if you're at, say your limit is $1,000 and your balance is $500, that's a 50% utilization. And credit companies, they want to see it at 30%.
30 or lower.
Yeah. So we pay those credit cards down, boost up the credit score. So now she doesn't have quite as much money to put down and put towards closing costs, but there's other things that we can do to make up for that, whether it's seller concessions or a lender credit, or just, looking for a cheaper house too. But did I answer the question? I don't even think I did.
You were talking. You were making points about what he asked you. This is about like what disqualifies somebody. So like if you have somebody that they don't have a very extensive credit history, such as they just got their first credit card 5 months ago,
right?
And that's all the credit history they have. That can really make or break you, because if you make those payments on time for those 5 months, your credit's going to be stupendous. But if you miss one of those payments, I've literally seen people completely get disqualified from the home buying process
Go
while
from
they
an
were
800 down to a 500.
while they were under contract. Yes, he missed a payment on. It was funny you brought up the Sears card. It was like one of those big box retailer stores, and they do a horrible job notifying when your payment's ready. And if you're not on top of that stuff, you're gonna miss it. And he missed it, and like he thought he had auto payment on, he didn't, and his credit went from like a 620 down to like a 560, and that completely killed the deal.
Yeah.
Because of something so silly and small. He didn't have enough credit history to essentially take that blow, and it just completely disqualified him. And it was really sad. They were devastated. And it's insane. Something as little as that they didn't even consciously realize was going on until after the fact.
Yeah.
Do you guys have a sweet spot as far as the types of mortgage? I mean, I've heard the term jumbo mortgage, and that's for the types of houses that I'd never be able to afford.
Yeah. Yeah. Likewise.
The ones that have like 4-car garages and more that you'd park like cars that end in the Val
Helicopter
the garage
on top. Yeah.
We do pretty much anything. Yep. We can broker loans as well. We do
What's a broker loan?
It's just where we don't fund it ourselves. We go through a broker. Yeah. Those are your real out of the box or DSCR loans, which is I don't remember what
investor cash flow loan. It's a really cool loan for investors where they can essentially buy the property and they don't look at any other qualifications outside of the anticipated rental income. So they qualify them based off of what the appraisal tells them they'll be making on a monthly basis. But there's things to it, like you have to have owned a primary for at least a year ahead of time.
Fit in the box,
right? There's and see that kind
and they have higher rates, and so it's not like it sounds really glamorous, but it really truly is just for investors, not for someone.
Get your hands on the property,
exactly. There's bank statement loans.
Yep.
For self-employed borrowers. That's a big issue too. We touched upon credit score before, but another big issue for buyers is their type of income. So if you're self-employed, you've got to show that you've got that steady income, not just this is what I made this last quarter. They're going to go all the way back 2 years, sometimes even 5 years.
Oh, wow.
Depending on what, especially during the, with the pandemic, there was a big dip in a lot of people's income. So was that due to the pandemic or was that due to
something else?
The business itself. But so they'll look at that. So a lot of people that are self-employed will do the bank statement loans, and they just look at the money coming in versus the money coming out. Pretty straightforward in that. But
I know it's a little bit of a conundrum because every self-employed person I know tries to minimize their income.
Exactly. And that's exactly what
that's a huge issue.
$12, leave me alone, okay?
That's a huge issue for us, actually, because they might make $150,000 a year, but on paper it looks like they make $35,000, and now we can only work with $35,000 of income. Yeah. And it just makes it a
lot of people just don't understand that. So you can plan for that accordingly, but
well, it's all about risk management too, as well.
Exactly.
You can't make a loan that's going to be defaulted on.
Mm-hmm. We don't like that.
That's a lose for everybody.
Yeah.
Home equity.
We do those. Yep.
Okay. Mm-hmm. And refinancing, I guess.
Not as of recent, but we do them. We do them. They haven't had many opportunities lately.
Well, actually, there is. A lot of people not walk around, but like they think everything's hunky-dory because their mortgage is at 2.75%, but meanwhile they're carrying 25-30% in tens of thousands of dollars of credit card debt and car loans at 10%, and you get a blended rate of 8%.
Yeah.
And that blended rate is when you take all of your debt all together and all of the interest rates, and it averages all out and say, if you were to put everything into one bucket and the payment stream and all of that, you're at an 8%. There's a little calculator that we use for that.
Okay. And
people get surprised with that. And they're sitting on, so much equity. Just do the cash out refi, pay off your debts at, a 5-6% rate, and you're going to be better off. Yeah, you're going to lose that 2.75%, but
it might actually save you money on a monthly basis. Now, if there's any piece of this podcast that gets put across the social medias, make it that piece, because a lot of people don't understand that. They think I've got my 2.5%, I'm good. But in reality, there is net tangible benefit all over across the board for these types of people if you just take a second to look at their situation and really break it down for them. It makes sense. Numbers are numbers.
Yeah.
Makes sense. What's the market doing right now? I mean, obviously we know that interest rates are very high.
It's relative
they went
term.
up.
When you bought a house in the 90s,
I was going to say, you were talking about that 9.5%.
My first one was at 7.5%.
Okay.
ooh, you got a deal. My first house was 8%.
Yeah.
And we refinanced at 6%. And
It went
did
down.
all that.
I mean, so,
Fantastic.
all the new buyers aren't getting a whole lot of sympathy from me, but I mean, we were at ridiculous. I don't know whether it's ridiculously low, but we were at very low rates.
Yeah. It'll never be that low again.
And
It was not healthy.
no, it corrected. It's overcorrected. Some people may argue at up to around 7 or so. I mean, where do we stand now? And
6s. I've been quoting 6s.
Some cases, depending on the loan program, we can get into the very high 5s.
Yeah.
It just depends on the qualifications of the buyer. But, as
And you can always buy the rate down too.
Yep.
Well into the 5s for sure. Yeah.
what do you mean by buying the rate down?
Buy the rate down means that you pay a discount point. Just one discount point is 1% of the loan amount, and then you get a lower rate. So you could do a half a point, a quarter point, 2 points. That's based on.
That's putting more money down on the house.
Technically, yeah. It's not.
Okay.
It's not putting it down because it doesn't go to your down payment. That is a fee.
Right.
It's a sunk cost. You're never going to get that back. But if you know you're going to live in the house,
so is it a fair to say it's a prepayment on your mortgage?
No. Look at it as a closing cost. Look at it as a fee. It's just a cost. It's a cost of getting the rate that you're getting because it's nothing tangible and you're never going to get it back, but it's going to get you a lower interest rate. Now, this is not the time to be buying down your rate, in my opinion. Back in 2020, when we were in the 2s, absolutely buy down that rate as low as you can because you're never going to have that opportunity again. But where we are currently, we're in a spot where we're anticipating refinancing in the next 12 to 24 months anyways. So the last thing we want to see you do is spend thousands of dollars buying down a rate that's not even going to be your rate for the entire term of the mortgage.
Yeah.
Is there a better time of the year to buy? I mean, I know that you hear realtors will say, you can probably get a better deal in the winter or the spring or something like that. I mean, is there a better time from a financial point of view to jump into homeownership?
Absolutely.
I don't think so. Do you?
No, this is good. This is good.
Yeah.
And this corner, that's why I looked at it.
Financial aspect, not a real estate market aspect.
Well, I do beg to differ to a degree because from my experience in the wintertime, it's winter, it's cold, Christmas is coming. People are maybe traveling south for the holidays. They want to go there's less people out here looking at homes. So when the winter rolls around, I'm preaching from the mountaintops. First-time home buyers, go get pre-approved, come back and get back involved, go see these homes because more times than not, there's a lot less barrier to entry and a lot less competition during the winter time. I bought my first house in the winter. There was no competition. We were able to obtain a seller concession. Whereas if I went in during the spring market or the summer market, there's likely 3 or 4 other buyers trying to do the same thing. And it takes away my power to negotiate as the buyer. And it essentially puts us in what is known as a seller market. And that's what we've really been in for the last 3 years outside of the short winter months. Because during those winter months, a lot of people say they see their production drop. Mine always goes up. And it's because I know it's easier to get your offer accepted during that time because there's so much less competition.
More motivated sellers. But so we are in agreement because to me, that's more of a real estate market reasoning. But
from a financial
it has a financial twist on it because
the only thing that that's why I was saying kind of disagree because I don't think I could have obtained a seller concession during a spring or summer market, whereas during the winter, I was able to get $9,000 free from the seller of the property. And in some cases, offering less than they're actually asking for. So now that's even more if it appraises at what they were originally asking for.
Well, there's so much that goes into that, how long the house has been on the market and everything else like that. And I mean, as a consumer coming into the winter holidays, you're worried about, I got to buy all the Christmas gifts. I've got some travel, and then January rolls around and those darn credit card bills that are going to ding my credit score are going to come in because my utilization went up and everything else. So, I mean, what you're saying, Joe, does make sense to me that, you get in there, if the house has been on the market for a while and they're like, okay, fine, we'll take.
And who wants to put their house on the market during the holidays to begin with?
Well, they're probably not. But if it is on the market in the holidays, it has been probably for a while. There's an assumption on my part. Yes, okay, let's drop the price a little bit. And I'm not thinking about moving out until March, April, May. And then that's a negotiation, but it gets somebody into the house. Yeah. And
but as far as rates go, rates are not seasonal.
Right. They're not based off anything besides just the way
based
various
off
economic
what the Fed
indicators.
says.
Yes.
Not what they do, but what they say. It's maddening. Yes. That's a whole nother podcast.
Yes.
I had never thought to be honest with you, about dealing with the houses that I bought, not that there's a zillion of them, has always been driven by the realtor. And I've never really thought that, hey, I need to put the cart before the horse.
If you're
I guess you're the horse on this point. You're the horse before the cart.
People don't know that they're going to move. They get the job transfer. They got to be in and out in 3 months. Then absolutely, you got to talk to the real estate agent. But your first time home buyers, they're mulling this over. They're can I? They don't think that they can, so they don't talk to the real estate agent. When in reality, they absolutely can.
Right.
Especially your new college graduates, because that is one of the other big myths, is that you have to have 2 years of job history. Well, when you're a college student, if you get a job right out of college, which most college students do, at least in recent years they have, and you get a job in the same field that you studied, your student history or whatever, your academic history counts as your job history. All we need to see is a
non-contingent offer letter.
Yeah, yep. A degree and yeah. So both my daughters did that. They bought houses within weeks of graduating from college.
Really?
Yeah.
So I can walk out with my diploma and my couple $100,000 worth of college debt and an offer letter.
An offer letter, yep. So all you need is one paycheck. You got to show up to the job, because just get you the offer doesn't necessarily mean that you're going to take it.
And I also just want to emphasize it has to be a non-contingent offer for us to utilize it. So like if you just got a job with the government and one of those contingencies on that offer letter is passing a drug test and getting your clearance, we technically can't write that loan for you until those are cleared. And you have been given that job, not you'll have this job if you do this.
That's right. That makes sense. What's the best way to do business with Movement? Contact you at movement.com.
And reach out to us directly.
Okay.
She's on Instagram.
Well, we're both on social media. That's a good way to just kind of follow along, get some good tips. And all of our contact information is in there too.
Well, we'll make sure that we put all the links directly to your pages and everything else in the show notes as well. But movement.com, check it out. This is a local company that's deeply embedded in the community. I mean, Lori and I are together on SOFO, the South of Forest Business Association. You are always out there. You were a cheerleader for the Bernie House, as well as their Mardi Gras Ball, which was just a couple weeks ago. Another sold out, wonderful success.
Yeah, it was amazing. Yeah, absolutely.
And I've learned so much about this as far as the whole transaction process with come in, look to find out what you can do. And then you go armed with that to your realtor.
Yeah.
And I think realtors would probably appreciate that, as opposed to me saying, hey, let's go look at these $10 million homes.
Right.
And then finding out after the fact that I need to be in a, Montana and in a shed where I can come in and say, hey, I was just talking to Movement and they said that I qualify for $500,000.
Yeah. And I will add to a pre-approval from a local lender such as Movement is much stronger than in online.
100%.
Yeah. I'm not going to name names, but yeah.
Earlier, I guess so, because you got it's a personal thing, it's a relationship thing.
Yeah. Well, we're gonna ask the questions behind the questions of tell me a little bit more about your current situation or this little comment on your credit report, and a lot of online lenders won't necessarily look into that. Yeah.
There's also a very unique feature to our market that in Baltimore there's a lot of leaseholds where you don't own the land that your home is on. And lenders that are not from here, they don't know what that is. They have no clue what that is. I actually just won a deal recently because they were offering my client $10,000 just to work with them. And the realtor got on the phone with them, as they do, and said, hey, this is a leasehold. And they said, what the heck is that? And he goes, oh my gosh, you're not going to be able to do this. Like it's a whole process that goes into it.
Underwriting, yeah.
That only your local lenders really know about. And there's little nuances like that pop up all the time that if you're not from here, you're not going to truly understand what it is you're working with. And it's just going to make the entire loan process that much more difficult on everybody.
Well, you've got a team here at Movement Mortgage that's looking to work for you. I mean, you don't want to see anybody not get into their home.
Right. Exactly.
And obviously you're in business to be in business. So, I mean, it's got to be good loans and everything else. But I would suggest, if you're in the market for a first home or a second home or a refi or a home equity line,
give it a call.
Give it a shot. And I'll have all the links and information and phone numbers and everything else into the show notes. Hey, thank you guys so much.
Thanks for having us.
Thanks for coming out.
Thanks for listening to this week's Local Business Spotlight. Please make sure to visit eyeonannapolis.net for all your local news, events, and opinion. And in case you haven't already, please subscribe to the Eye on Annapolis Daily News Brief, where we bring you all the day's local news direct to your phone, tablet, or computer in about 10 minutes. It comes to you at 6 a.m. every Monday through Friday, and you can subscribe on Apple Podcasts, Google Podcasts, or wherever you get your podcasts.